The S&P 500 is one of the best financial inventions ordinary investors have ever been given. I say that plainly because I do not want you to misunderstand what I am about to tell you. For most people, for most money, over most long periods of time, a broad index of the largest and most productive businesses in America is a very good machine. It is simple, it is diversified, it removes a great deal of human foolishness from the process, and over long periods it has historically compounded at roughly 10% a year. That is already powerful. But in investing, the difference between good and a little better can become enormous over time. Most people underestimate this because the human brain is not designed to feel compounding. It is designed to feel the present. It can feel $1,000 today. It cannot easily feel what 3 extra percentage points means over 30 years. That gap is where fortunes are made. Let me make it simple. Imagine you have $10,000, you invest it once, and you never add another dollar. If that money compounds at 10% a year for 10 years, it becomes roughly $26,000. That is good. That is the kind of result that can make a person feel intelligent and patient. But if that same $10,000 compounds at 13% a year instead, it becomes roughly $34,000. If it compounds at 15%, it becomes about $40,000. And if it compounds at 17%, the number moves toward $48,000 at first. This may not feel life-changing. A person might say, why should I change anything for the difference between $26,000 and $48,000? That question itself is the problem. The game is not 10 years. The game is not one deposit. The game is time, repetition, behavior, and compounding. When you take that same $10,000 and stretch the timeline to 30 years, the difference changes character. 10% a year can take it to roughly $174,000. 13% can take it to roughly $395,000. 15% can take it to roughly $662,000. 17% can take it toward $1,100,000. The starting amount did not change. The person did not work harder. The difference came from the rate of compounding and the time allowed for that compounding to work. That is the first principle. Small differences in return become huge differences when they are multiplied by time. Now, this is also where people become dangerous to themselves. They hear that a slightly higher return can change everything, and then they begin chasing anything that promises a higher return. They buy what is exciting, they buy what went up last week, they buy what someone on the internet said would make them rich. They confuse higher expected return with free money. That is not how a good investor thinks. A good investor understands that higher return usually comes with higher volatility, higher concentration, or higher behavioral risk. There is no such thing as extra return without some kind of extra burden. Sometimes that burden is temporary volatility, sometimes it is sector concentration, sometimes it is valuation risk, sometimes it is the risk that you panic and sell at the exact wrong time. So when I talk about trying to do slightly better than the S&P 500, I am not talking about gambling. I am not talking about meme stocks. I am not talking about trading every headline. I am talking about understanding which broad baskets have historically produced stronger returns, why they did so, what risks came with them, and whether you can hold them through the periods when they disappoint you. That last part matters more than people think. The best investment in the world is useless if you cannot hold it when it falls. Before you look at any ETF, you need to understand what the S&P 500 actually is. It is not magic. It is not a guarantee. It is a system. It is a group of roughly 500 of the largest companies in the United States stock market. When you buy an ETF like SPY, you are not buying one business. You are buying a slice of many large businesses at once. You own a little bit of companies that sell software, chips, hamburgers, cloud computing, consumer products, industrial equipment, payment networks, and almost every other major part of the American corporate machine. There is a very important feature inside that machine. If a company weakens enough and no longer belongs among the largest and most relevant companies, it can be removed and replaced. The index is not emotional. It does not keep a company because it used to be great. It follows rules. That is one reason index investing works better than most individuals. People fall in love with old winners. Rules do not. If one company loses its edge, the system eventually adjusts. If a new company becomes important enough, it can enter the system. That means the S&P 500 is not a frozen list. It is a living representation of large American business power. That is why I respect it. Over long periods, even with recessions, market crashes, oil shocks, inflation cycles, credit crises, pandemics, and wars, the broad U.S. stock market has still rewarded the patient owner. Not every year, not smoothly, not without frightening declines. But over long enough periods, productive assets tend to rise because companies adapt, earn, reinvest, and raise prices over time. The mistake most people make is that they want the long-term return without the long-term behavior. They want the 10% average, but they cannot tolerate the year when the market falls 20%. They want compounding, but they check the price every morning. They want wealth, but they think in weeks. That is not investing, that is emotional polling. Now, once you understand the SP 500, you can begin asking a more advanced question. If the SP 500 is the broad machine, are there parts of that machine or adjacent machines that may grow faster over long periods? The answer is yes, but the answer is not free. The first example is growth. A growth-focused ETF takes the broad market and tilts toward companies that are expanding faster. These are often companies whose earnings, revenues, or market expectations are growing more rapidly than the older, slower, more value-oriented businesses. In a simple sense, this is the same American corporate system, but with more emphasis on the businesses that are expected to grow at a higher rate, that can work very well in the right environment when capital flows toward innovation, when interest rates are supportive, when profits are expanding. Growth companies can outperform. Over the last decade, growth-oriented funds have done very well. Some have produced returns close to or above the broad market depending on the exact period measured, but you have to understand the trade-off. Value companies, slower companies, and dividend-paying companies can sometimes protect the portfolio during downturns. When you remove or reduce those, you may get more upside in strong markets, but you can also get more downside when the environment changes. That is why I never want people to hear the word growth and immediately think better. Better depends on the cycle, better depends on price, better depends on the investor's ability to hold. A growth fund is not a magic engine. It is a tilt. It says, I want more exposure to faster, growing businesses. If those businesses keep executing, the tilt can help. If valuations become excessive or the cycle turns against them, the same tilt can hurt. That is the second principle. Every higher return strategy has a reason it may work and a reason it may fail. The next example is technology. A fund like XLK narrows the exposure further. Instead of owning the entire SP 500, it owns the technology companies inside it. That means fewer businesses, more concentration, and more dependence on one broad economic engine. Technology has been one of the strongest engines of the last several decades because it does something very powerful. It improves productivity. It allows companies and individuals to do more with less software scales. Semiconductors enable new systems. Cloud computing lets businesses access infrastructure they could never build alone. Digital platforms can reach billions of people when technology works. It can produce extraordinary margins, extraordinary growth, and extraordinary compounding. That is why technology funds have historically beaten the SP 500 in certain long periods. A tech ETF like XLK has produced very strong returns over the last decade because the largest technology businesses became more central to the economy, not less. But again, the risk is in the same place as the opportunity. If you own more technology, you are making a statement. You are saying that the future will continue to reward digital infrastructure, software, chips, cloud systems, and productivity platforms. That may be right. It has been right for a long time, but markets do not move in straight lines. Technology can become expensive, regulation can rise, competition can compress margins, interest rates can change the value investors place on future growth. So the question is not simply whether technology is good. The question is whether you can hold a technology-heavy fund when it falls harder than the market, because it will at some point. If you cannot hold it through the drawdowns, you do not own a strategy. You own a stress test waiting to expose you. Then there is defense and aerospace. This is a very different category because it is not driven by the same forces as consumer technology. A defense ETF such as PPA gives exposure to companies that build aircraft, missiles, satellites, cybersecurity systems, aerospace components, and defense infrastructure. This is where people often feel moral discomfort, and they should think about that carefully. I believe every investment needs to pass 3 tests for the person making it. It must make financial sense, it must make legal sense, and it must make moral sense to you. No one else can decide that third part for you. From a financial perspective, defense can be attractive because government spending does not behave like consumer spending. A consumer may stop buying expensive goods during a recession, but a government facing geopolitical tension does not simply stop funding defense. In fact, when uncertainty rises, defense budgets can become more important. That gives the sector a different kind of demand base. It is not immune to volatility, nothing is, but it is tied to long-term government contracts, national security priorities, and geopolitical cycles that do not disappear just because the consumer is weak. That is why defense and aerospace funds have historically produced strong returns in certain periods. They benefit from a world that remains unstable. And unfortunately, if you study history, instability is not an exception, it is part of the system. But here again, the investor must be honest. Some people should not own defense companies because it does not fit their values. That is acceptable. The point is not to force yourself into an investment because it has performed well. The point is to understand the mechanism defense spending follows the incentives of governments. If geopolitical tension rises, money flows toward the companies that supply the tools of national security. Whether you choose to invest in that is a personal decision. The next category is momentum. A momentum ETF like SEMO looks at the companies in the SP 500 that have been moving the strongest and concentrates in the top names with the strongest price momentum. This is a very different logic from value investing. A value investor says, I want to buy what is cheap relative to fundamentals. A momentum investor says, I want to own what is already working, because strength can persist longer than most people expect. This can feel unnatural to many people. They are taught to buy low and sell high. Momentum sometimes feels like buying high and hoping it goes higher. But markets are not governed by slogans, they are governed by flows, psychology, earnings, positioning, and liquidity. Sometimes what is strong keeps getting stronger because institutions continue buying, earnings keep improving, and the market keeps rewarding the same leaders. This is especially true in periods when leadership is narrow and the winners attract more capital. A momentum fund systematizes that behavior. It does not ask you to guess which company will be strong. It follows rules that select companies already showing strength. That can outperform, but it can also reverse quickly. Momentum works until the momentum breaks. When leadership changes, a momentum strategy can lag or fall sharply as yesterday. Strongest names become tomorrow's crowded trades. This is why you must understand what you own. You are not simply buying the SP 500, you are buying a rule-based system that chases strength within the SP 500. That is the third principle. A good strategy is not good because it always works. A good strategy is good because you understand when and why it works, and you can survive the periods when it does not. Then we come to semiconductors. A semiconductor ETF like SMH has been one of the strongest examples of sector outperformance because chips have become the nervous system of the modern economy. Phones need chips, cars need chips, factories need chips, medical devices need chips, defense systems need chips, cloud infrastructure needs chips, artificial intelligence needs enormous quantities of chips. When the world becomes more digital, the demand for computation rises. When the demand for computation rises, the demand for advanced semiconductors rises. When artificial intelligence moves from novelty to infrastructure, the chips that power it become more central. That is why semiconductor funds have delivered extraordinary returns over the last decade. In some periods, they more than doubled the SP 500's annualized return. That kind of performance gets people excited, and excitement is dangerous if it replaces understanding. The semiconductor industry is powerful, but it is also cyclical. It has shortages, gluts, capital expenditure cycles, geopolitical risk, supply chain complexity, and fierce competition. The businesses can be magnificent, but the stocks can be volatile. When expectations become too high, even a great company can disappoint. So when someone looks at SMH and says, it has done 30% a year, I want that. They are looking at the reward without looking at the path. The path matters. If you cannot tolerate a deep decline, you cannot own a highly concentrated semiconductor fund responsibly if you believe in the long-term demand for chips, AI servers, data centers, advanced manufacturing, and digital infrastructure. Then you can consider it as part of a broader portfolio. But if you buy it because the chart looks beautiful, you are not investing, you are reacting. The final broad example is QQQ, the NASDAQ 100. This is not a pure technology fund, but it is heavily tilted toward large non-financial companies, many of which are technology or technology-adjacent businesses. QQQ has historically outperformed the SP 500 over certain long periods because it has owned a large share of the companies that became dominant in the digital economy, but its volatility is higher. When markets rise, it can rise faster. When markets fall, it can fall harder. That is the nature of concentration. A person who buys QQQ must understand the trade. You are accepting more volatility in exchange for a chance at higher long-term growth. You are saying that the largest non-financial innovators and platform companies will continue to capture a large part of economic value. That may be a good thesis. But again, the thesis is not enough. You need a system. This brings me to the part of investing that most people ignore because it is less exciting than tickers. The system matters more than the product. People want to ask, which ETF should I buy? That is the wrong first question. The better question is, what behavior can I repeat through the cycle? because the hardest part of owning broad ETFs is not picking them. The hardest part is buying them when they are down, holding them when they are hated, and not selling them because the news made you feel unsafe. There is a phrase that I like because it is simple enough to remember: always be buying. That does not mean blindly throw all your money into the market at once. It means build a consistent process. Each week or each month, money leaves your checking account and goes into your investment plan. It happens whether the president is a Republican or a Democrat. It happens whether the news is optimistic or terrifying. It happens whether the market is at a high or falling sharply. Why? Because the cycle is not predictable enough for most people to time. If you wait for clarity, you will usually miss the move. Markets price the future before the average person feels better. By the time your emotions tell you it is safe, the price is often already adjusted. That is why consistency beats intelligence for most investors. But always be buying is only half of the system. The other half is buy the dip. When markets fall and you own assets you truly believe are productive, diversified, and worth holding for the long term. The decline is not only a problem, it is also a price change. In 2022, a 20% decline allowed disciplined investors to buy the market at a 20% discount. In 2020, a sharp crash gave investors the chance to buy at dramatically lower prices. In 2008, the market was cut in half, and those with cash, courage, and a system had the chance to acquire future wealth at distressed prices. The problem is that most people do not have cash when opportunities arrive, because they spent too much, borrowed too much, or invested emotionally. Then, when markets fall, they are forced to sell or freeze. They do not buy because they are afraid. And they are afraid because they did not prepare. Preparation is what turns volatility from enemy into opportunity. This is one of the core principles I have learned from studying cycles. Crashes feel unique when you are inside them. Every crash has its own story. Inflation, war, banking stress, recession, pandemic, overvaluation, political crisis. But beneath the story, the pattern repeats. Fear rises, liquidity tightens, prices fall, weak hands sell, strong hands acquire. Then time passes, the world adapts, the best businesses keep producing, the market recovers, then eventually reaches new highs. That does not mean every asset recovers. It does not mean every ETF is safe. It does not mean valuation does not matter. It means that if you own broad, productive, well-structured assets and you have the temperament to keep buying through the cycle, the periods of fear often become the periods that create the largest future returns. But you cannot improvise that behavior. You need rules before the storm if your plan is to buy every month. Define it before the market falls. If your plan is to buy more when the market drops 20%, define that before the headlines tell you the world is ending. If your plan is to hold a more concentrated ETF like XLK, SMH, SMO, PPA, or QQQ, decide in advance what level of volatility you can survive. The investor who decides in advance is calm. The investor who decides in panic is usually wrong. Now, let me bring this back to the original point. The S&P 500 is a strong foundation. There is nothing wrong with owning it. In fact, many people would be better off owning only a broad index and never trying to do anything clever. The more a person tinkers, the more chances they create to make mistakes. But if you want to try to do slightly better, you must understand the trade-offs. Growth funds can emphasize faster growing businesses, technology funds can concentrate in the digital economy, defense funds can align with government and geopolitical spending, momentum funds can follow strength. Semiconductor funds can target the chip infrastructure behind AI and digital systems. QQQ can tilt toward the largest non-financial innovators. Each one has a reason it has worked. Each one has a reason it can hurt you. That is investing. There are no assets that are simply good. There are assets that are good at certain prices, in certain environments, for certain investors, with certain behavior. The most dangerous person is the investor who looks only at past returns. Past returns are a history lesson. They are not a contract. The fact that an ETF did well for 10 years does not mean it will do well for the next 10. But it does tell you something about what forces have been rewarded. It tells you where capital has flowed. It tells you which industries produced earnings growth, innovation, and market leadership. From there, you must ask whether the forces are likely to continue. Will technology continue to matter? Will chips continue to matter? Will AI and data centers continue to require semiconductors? Will geopolitical tension continue to support defense spending? Will momentum continue to capture market leadership during strong trends? Will the largest innovative companies continue compounding? These are not certainties, they are probabilities. A good investor does not need certainty. A good investor needs a sound thesis, proper sizing, diversification, and a repeatable system. That is why I would never tell someone to abandon the SP 500 and put everything into one aggressive ETF. That is concentration without humility, and markets punish investors who have no humility. The wiser approach is to think in layers. The first layer is the core. This may be the SP 500 or a total market fund. It gives broad exposure to the productive economy. It is the foundation. The second layer is the tilt. This is where you may allocate a smaller portion to areas that you believe can outperform over long periods, such as technology, semiconductors, growth, defense, momentum, or the NASDAQ 100. The third layer is the system. This is where you determine how much you will invest, how often you will invest, and what you will do when markets fall. The system keeps you from becoming your own worst enemy. If you do not have a system, the market will create one for you. It will make you excited near tops and terrified near bottoms. It will push you to buy after a big move and sell after a decline. It will make you confuse action with intelligence. That is how ordinary investors underperform the very funds they own. The fund may return 10%, 15%, or more. But the investor returns less because he buys late, sells early, stops contributions during fear, and changes strategies every time a new narrative appears. The ETF is not the weak point, the person is. That is why behavior must be the center of the process. I want you to think of compounding as a machine with three inputs. The first is the amount invested, the second is the return earned, the third is the time allowed to pass. Most people obsess over the second input and ignore the other two. They want the highest return, but they do not invest enough, or they invest enough but cannot stay invested long enough. Or they have time but waste it by constantly moving between strategies. The investor who wins is usually not the one with the most complex portfolio. It is the one who invests consistently, keeps costs low, avoids emotional mistakes, uses tax-advantaged accounts when possible, holds productive assets, and buys more when good assets become cheaper. That sounds boring. Boring is underrated. Boring done consistently for 30 years often beats brilliant done emotionally for 3 months. Now, there is another point that matters. When you try to outperform, costs matter. One of the reasons ETFs became so powerful is that they can offer diversified exposure at very low expense ratios. Fees are small numbers that become large numbers over time. A 1% fee may sound harmless in a single year, but over decades it can remove an enormous amount of wealth from your compounding engine. This is why low-cost index funds and ETFs changed investing. They took a great deal of unnecessary friction out of the system. If you are going to use ETFs to seek better returns, you still need to pay attention to costs, liquidity, holdings, concentration, and turnover. You should understand what the fund owns, how it selects holdings, and why it should exist in your portfolio. Do not buy a ticker, buy a system you understand. When you look at a fund like XLK, ask what part of the economy it represents. When you look at PPA, ask what cycle supports it. When you look at SMEO, ask what rules determine the holdings. When you look at SMH, ask how much of the fund depends on the semiconductor cycle and AI infrastructure. When you look at QQQ, ask how concentrated you are in the largest non-financial companies and whether you can tolerate the drawdowns. If you cannot explain why you own something, you probably should not own much of it. That does not mean you need to be a professional analyst. It means you need to be clear. Clear thinking prevents bad decisions. And then once you are clear, the next job is to avoid being shaken out. Every long-term investor will live through frightening markets. If you own growth, there will be times when value looks smarter. If you own technology, there will be times when technology is hated. If you own defense, there will be times when defense lags. If you own semiconductors, there will be brutal cyclical declines. If you own QQQ, there will be periods when it falls much harder than the broad market. You must expect this. An expected decline is easier to survive than a surprising one. If you believe an asset can fall 30 or 40%, you size it differently. You do not put all your money into it. You do not invest money you need next year. You do not use leverage. You do not build a portfolio that requires perfect timing. You build a portfolio that can be wrong for a while and still survive. Survival is the first rule of compounding. If you survive, you can keep playing. If you keep playing with productive assets, time can work for you. If you are forced out, time stops helping you. That is why cash reserves matter. Not because cash is a great long-term investment, because it is not. Inflation erodes it. But cash gives you optionality. It prevents you from selling long-term assets during short-term fear. It gives you the ability to buy when others are forced to sell. A reserve is not a return engine, it is a shock absorber. Most investors forget the shock absorber until they hit a bump. By then, it is too late. So when I look at the idea of beating the SP 500 with ETFs, I do not see a simple list. I see a set of trade-offs and a behavioral test. Can you own growth without chasing every hot theme? Can you own technology without panicking during a tech sell-off? Can you own defense while making sure it fits your values? Can you own momentum while understanding it can rotate suddenly? Can you own semiconductors while accepting cyclicality? Can you own QQ while accepting bigger drawdowns? Can you keep investing every month? Can you buy more when the headlines are terrible? Can you avoid comparing your portfolio to someone else's best month? Can you stay humble when you outperform and patient when you underperform? Those questions matter more than the tickers, because the market is not merely a machine of numbers. It is also a machine that reveals character. It reveals whether you are patient. It reveals whether you are honest about risk. It reveals whether you understand your own emotions. It reveals whether you have a plan or only a desire. Desire is not enough. Everybody wants higher returns. Few people are willing to build the structure that higher returns require. The structure is simple, but it is not easy. Have a foundation, know what you own, keep costs low, diversify intelligently, add tilts only where you have conviction, invest consistently, buy more during fear, never invest money you cannot afford to leave alone, never use a strategy that depends on you being emotionally perfect, because you will not be emotionally perfect. No one is a good system protects you from yourself. That is the real lesson. The S&P 500 may remain one of the great long-term wealth builders. Some ETFs may beat it over the next decade, some may not. The exact winners will only be obvious in hindsight, but the principles will not change. Compounding rewards time. Risk and return are connected. Concentration cuts both ways. Costs matter, behavior dominates intelligence. Crashes create opportunity for those prepared to use them. And slightly better returns repeated for long enough can change the whole outcome of a financial life. So do not hear this as a promise that any specific ETF will make you rich. Hear it as an invitation to think more clearly. If you want broad simplicity, the S&P 500 is a powerful core. If you want a chance at stronger returns, study the funds that have historically outperformed and understand the forces behind them. If you believe those forces will persist, size them appropriately. If markets fall, do not panic. If your thesis remains intact, buy with discipline. Always be buying. Buy the dip when the dip is in something you truly understand and want to own for the long run. And above all, remember that the goal is not to beat a benchmark for 1 year. The goal is to build a life where your money works in a disciplined system while you remain calm enough to let time do what time does best. Because wealth is rarely created by one perfect decision. It is created by a series of sound decisions, repeated without emotional sabotage, through cycles that scare other people out of the game. That is how you use ETFs intelligently. That is how you seek better returns without turning yourself into a gambler. And that is how a small edge respected for decades can become a very large difference.